After going on an incredible run over the past couple of years, SoFi stock seems like it's lost the magic. It is down almost 30% from the high just this year. It's down a lot more than that from the high reached last fall. Is the best over for SoFi? Is it time to move on? Or is the market giving us an opportunity to buy? I'm Jason Hall. This is Investing Unscripted. I'm going to tell you why I think right now is a really compelling time to buy SoFi stock and hold for the long term. Before we get into the details, though, we get to make these great videos because we have a great partner. This video is sponsored by the Motley Fool. If you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. Go to fool.com/unscripted. You can get access to the Motley Fool's 10 best stocks to buy right now. It's a great way to supercharge your investing, find some great stock ideas, and also help us continue to make great content that helps you out too. Okay, let's start with a look at what's going on with SoFi stock this year. Since the first day of trading, down 21%, we start stretching that out. From the all-time high, the stock is down 35%, but still up over the past 12 months. We stretch it out a little bit further, and you can see the stock has done extraordinarily well over the past few years. Investors have to be asking themselves, though, with the sell-off that started, is this a long-term trend? Or is this just another blip on the radar like we saw back at the beginning of last year? I'll tell you this, I think most likely, this was going to represent a pretty good opportunity to buy. Let me break down why. SoFi just reported its Q4 results and its full year 2025 results. And what did we see? Continued really, really strong growth. Last year, member growth was 35%. Products was 37%. In other words, a lot of new members were adding products, or existing members were adding products even as new members were joining. We saw that carry over to drive revenue. So again, 35% member growth, 37% product growth, 38% adjusted revenue growth. So the company is doing a really good job of attracting more members, retaining members, and getting those members to steadily do more and more with SoFi. It's starting to pay off on the bottom line. This was a company that was losing money back in 2023, 2024, turned a modest profit, more than doubled that profit in 2025. Great story of growth, and the margins continue to get better too. You see it 13% adjusted net margin at the same time that it's growing, because you have to remember, and I know I get a lot of pushback from SoFi bulls when I say this, and I'm going to say it anyway, SoFi is more bank than fintech. Because of that, if you look at its balance sheet, its liabilities to depositors, so much of its assets are loans that it holds. That makes it a bank. Investors need to look at it as a bank because it has the risk profile of a bank. Yes, it has so many other financial services a lot of banks don't necessarily offer. Its payments platform that it provides to other fintech companies is, again, that's a differentiator. But again, this is a bank in terms of the way you need to think about the risk profile. But what we have seen is that now this other bucket right here, this dark blue, that's basically interest income. That's really what that mostly is. We can see that fee-based revenue has steadily become a bigger and bigger percentage of the mix. And last year, it was 43%. That was a substantial jump. What that means is that the company is starting to de-risk the way that it generates revenue as it adds more services, as its borrower customers with credit cards and personal loans take on more of those services that the business is offering. That fee-based revenue continues to grow. SoFi has also consistently done a pretty good job of de-risking its loan portfolio by securitizing and selling off part of that loan book, maintaining on the balance sheet the loans that it wants to keep, and selling off other assets to get a good match of risk, but also between the liabilities that it has with what it owes to depositors and the loans that it's carrying on its books. The loan business does continue to grow. The lending segment revenue was up 24% year over year. I like the fact that this is growing at a slower rate than its customer acquisition, because that means that that supports the idea that SoFi continues to lend responsibly and isn't lowering its lending standards just to grow at an outsized rate. The fact that we continue to see fees-based revenues grow at a faster rate than revenue from its lending business, again, I think those are really positive things, that the lending business is going well, but management isn't leaning into risk to try to grow as fast as it can. Here's another part of the loan business that I think is really compelling. Yeah, we're seeing personal loans at record levels, tremendous amount of origination activity that's happening, but they're also de-risking in another way though. And that's, if you look at the home loan business, is really starting to crank up. Was their best year ever in home loans. So that's helping also lower the risk profile versus personal loans, which again, these are unsecured loans, so they're higher risk. And then student loans, which generally is a pretty safe business, but leaning into home loans is something they're doing that I really think is compelling. Okay, last thing I want to share here that's really compelling to me is guidance. Continues to call for really strong growth, 30% adjusted revenue growth, really good adjusted EBITDA growth, net income. This is GAAP net income. They're looking for that to grow 72% this year from 481 million to 825 million, and very strong growth in earnings per share. Of course, dilution is hurting that. That's still going to grow 54% year over year to about 60 cents per share. Looking for a pretty strong beginning to the year, 12 cents in earnings per share. So about double year over year, 125% earnings growth. Not a surprise, continuing how quickly the business has grown and considering the size and scale that it's already at. Okay, let's wrap this up. What do we get in terms of valuation? One of the concerns I had with the business close to the beginning of the year, we have a savvy trader portfolio, and we actually sold off part of our position earlier this year when the stock was running up so much. I didn't think it'd come down quite this much, but the fact that it's come down this much tells me that there's an opportunity. So let's talk about valuation. All right, here's the stock price as I'm recording this after the market closed on February 4th, $20.76 a share. I'm going to zoom in on this right here so you can see it again. 60 cents a share is what management is calling for GAAP earnings per share in 2026. So what's the math there? About 35 times earnings. So yeah, that's expensive for a bank. But again, this is a business that's growing revenues at better than 30% a year. They're calling to grow revenue 30% a year in 2026. I think 34.30, call it 35 times earnings for 2026's earnings is a reasonable price to pay. I think SoFi has an incredible CEO, has a great value proposition, and is well positioned to continue to take market share in personal loans, student loan refinances, which that's the core of the business. And their mortgage business is an emergent business. You combine that with all of the other financial services and tools that they're providing that are growing even faster than the lending business. I think 35 times earnings is a reasonable price to pay for SoFi for investors that can stomach the volatility and intend to hold it and ride it out for the very long term.